Hey everyone! Today we're diving into a fascinating topic, America's $4 billion wind retreat and its implications for the energy sector. This might sound like a straightforward energy policy, but it's actually a complex and controversial move with far-reaching consequences. So, let's break it down and explore why this decision is more than just a simple shift in energy technology. First things first, the U.S. government is essentially paying companies to give up offshore wind leases and redirect their investments towards natural gas, LNG, or oil. This might seem like a strange move, but it's all about energy dominance, right? Well, not exactly. The administration argues that the leases were sold under unrealistic assumptions, and inflation, higher interest rates, and supply chain constraints have made offshore wind projects less viable. But here's the catch. These agreements are not just about the market choosing gas over wind. They're government-led decisions that socialize the cost of retreat and favor politically preferred technologies. Take TotalEnergies, for instance. They committed $928 million to LNG, oil, and gas investments before becoming eligible for reimbursement. They also agreed not to develop new U.S. offshore wind projects. This isn't about project selection. It's about technology selection. And it's not just TotalEnergies. Bluepoint Wind and Invenergy have made similar commitments, redirecting billions into LNG and gas-fired plants. Now, here's where it gets interesting. These companies are still investing in offshore wind elsewhere. RWE, for example, secured contracts for projects in the UK, proving that they don't see offshore wind as a dead end. So what's going on? It's all about the market and its priorities. America has abundant natural gas, and electricity demand is on the rise. Gas turbines can provide power when wind and solar can't, and they're essential for flexibility and near-term capacity. But here's the catch. Natural gas already supplied around 41% of U.S. utility-scale electricity in 2025, and adding more gas generation while removing wind options increases the price volatility of electricity. Natural gas prices can fluctuate, and growing LNG exports create a direct connection between domestic gas demand and global events. Wind and solar have intermittency costs, but no fuel price risk. Once built, their marginal fuel cost is zero. So, why is the U.S. government pushing this gas-dominated strategy? It's all about dispatchability and removing the hedge against gas shocks. But here's the deeper question. What does this mean for the U.S. power market and its future competitiveness? China is investing heavily in clean energy, and it's not just about rhetoric. They're building dominant supply chains through scale, repetition, and relentless cost reduction. Europe is also making strides, but it's slower and more bureaucratic. The U.S., on the other hand, is reimbursing companies for leaving the offshore wind market and calling it energy dominance. But here's the irony. American developers are still investing in clean electricity, with solar and batteries leading the way. So what's the takeaway? The U.S. power market is already voting differently, and a sensible administration would acknowledge the uneconomic leases, negotiate orderly exits, and reform permitting. They could support gas, nuclear, and geothermal without prohibiting wind returns. But instead, Washington is using public money to narrow its future options. And that's a big deal. It sends a signal that companies investing in long-lived factories and supply chains now know that an American energy market can reverse direction with an election, and they might even be paid to dismantle the previous direction. In the end, energy dominance built on yesterday's fuels is not dominance. It's dependence with better branding. So what do you think? Is this a strategic move or a costly mistake? Let me know your thoughts in the comments, and don't forget to like and subscribe for more insightful content. Thanks for watching.